morning, everyone. Happy October, happy Tuesday. So happy to see all of you today. Welcome you joining today's class, Unpacking President Biden's Green Book. I'm Pauline Lam from Cotai Realty, your 2021 co-chair, Education Committee, West and Gable Valley Realtors. A friendly reminder, all participants will be muted in the meeting, and should you have any questions, please enter it into the chat box. Speaker will answer your question during the Q&A section. This section is being recorded and will be available on the YouTube channel, West and Gable Valley Realtors. Now, I would like to invite Gloria Shaw, our Education Committee member, to introduce our very special speaker, well-known Mr. Tony Watson. Take it away, Gloria.
Hey everybody, this is Gloria Shaw with Remax Elite Realty. I'm also the member of Educational Committee in Western Gable Valley Association of Realtors. It's my honor to get a chance to introduce Tony Watson. Tony Watson is an enrolled agent who focuses on providing personalized financial guidance and tax preparation services to individuals and services and business. As a federal licensed tax practitioner, Tony helps his client make sound financial decisions and works to ensure all eligible deductions are received when preparing taxes. Should a client has any need assistance with audit, collections, or appeals, Tony is empowered by U.S. Department of Treasury to represent taxpayers before all administrative level of Internal Revenue Service. In addition to his one-on-one client work, Tony Watson is a keynote speaker for Robert Hall and Associate. He has spoken for hundreds of trade organizations throughout the state of California. His dedication to his clients and expertise in the field of taxation lead him to win the Glendale Reader's Choice Award for Best Tax Preparer in 2016. Tony, it's my honor to invite you to speak with our Association of Western Gable Valley. The board is yours.
Thank you so much, Gloria. Thank you so much for having me back. I can't wait to be back in person. Hopefully everyone is staying safe and staying healthy during these very strange times. And along with the pandemic and the CARES Act and everything that's been going on over the past 2 years, as we approach the end of 2021, we are also looking forward to hearing more about the finalized tax code, which should be in place hopefully by December 31st. It's just like the federal government to wait until the 23rd hour to finalize things. However, they have given us a little bit of a snippet into what potentially could be changing, and they're calling it the Biden Green Book. This Green Book is basically a wish list from the Biden administration as to what they would like to change and could potentially change, but nothing has been finalized as of today, October 20th. So over the next month to 2 months, we'll be hearing a little bit more about the Biden administration's timeframe to finalize this tax code, and hopefully before Congress recesses, I believe in December, first week of December, second week of December, we will have a finalized tax code in place. Make no mistake, though, once that final tax code is in place, it will be fine-tuned and changed over the following year to 2 years. It is very common for the federal government to pass tax code to see how that impacts the United States economy, and then fine-tune the phase-in and phase-out thresholds that are built into the new revenue code, as well as taking back or introducing new amendments or addendums to the IRC, the Internal Revenue Code. So let me go ahead and share my screen here so that you can all see. Share, and does everything look good on your end?
Look great.
Everything looks great. Okay, perfect. All right. So today's topic, unpacking the Green Book. So what essentially a Green Book is it is the introduction to what potential changes are on the horizon, and we're going to dive into some of the very unique and highlighted parts of Biden's Green Book. But once again, I do want to mention that none of this is final as of today. This is all very much speculation as to what will change once the federal government comes to I guess the House or the Congress comes to a bipartisan agreement as to what should change under the Biden tax administration. Once again, thank you for the introduction. Just a little bit about me. If you don't know who I am, I've been doing taxes, tax preparation and representation for going on 17 years. I am not only an enrolled agent practicing tax preparation and representing clients, but I am also the only keynote speaker with our firm at the moment. Hopefully we'll pick up some more speakers as the years go by. And right now, just in my personal clientele list, this number is a little out of date, but over the past 2 years, 3 years, I think that just under my column alone, I have clients who manage and deal with real estate dealings in the $350 to $400 million range now. And as a firm, well into the $1 billion range. So we see a lot here at Robert Hall & Associates. I'd say that 80% of our tax clients are real estate investors and small business owners. The other 20% would be made up of medical professionals, firefighters, teachers, police officers, other W-2 wage earners. But a majority of what we do here at Robert Hall is working with small business owners and real estate professionals. And over the past 2 years, I've been able to conduct double that number, about 250 webinars plus since the beginning of the pandemic. So we do really focus here on education as well, aside from just tax preparation services and other services. So aside from the tax preparation side of things, Bob Hall has been in business since 1971. So you can imagine how much business he's developed for himself since 1971 over the past 50 years. We have great reviews online, but we do offer more than just tax preparation services. We can incorporate your business. We can run payroll for your business. We do estate and trust planning. So we're pretty much a one-stop shop for any of your financial needs. So keep that in mind. If you have any questions not income tax related, we can absolutely connect you with professionals that can assist with your questions. We do offer free consultations. I'll remind you about this at the tail end of my presentation, but I do want to get into the meat and potatoes, so to speak, of today's webinar. So I'll show you that contact information again at the end. So this green book, it is being introduced now, just as suggestive changes to the Internal Revenue Code. I do believe that where the green book sits now, a majority of what we are going to discuss today will pass. There will be, once again, small addendums and corrections before it does pass through Congress, and there is an agreed upon Internal Revenue Code change. But there are a lot of changes on the horizon, changing certain things about the Internal Revenue Code that have been around since 1921, and some things that dated all the way back to 1962. So you're talking about major restructuring of the Internal Revenue Code, dealing a lot with real estate related scenarios. And once again, I said earlier that this is very much a wish list of the Biden administration, what they hope and they wish will change to generate more revenue for the federal government, not so much create more opportunity, but to redistribute certain levels of wealth across the United States. But let's make no mistake, at the end of the day, it's really just so the government can retain more income at the government level. I'm going to be real transparent about that. Nothing under the current tax administration looks good for at least myself and my clients who are real estate investors, but we'll have to wait and see where the dust settles at the end of the year. These proposals would significantly change the income brackets and the corporate tax rates for individuals north of $400,000 in taxable income and corporations that have a filing requirement as a C corporation. The S corporations and the LLCs will not see very much change under the new administration, but C corporations tax rates are set to change and increase based on what the current tax code has that tax rate set at. So we're going to talk in more detail about that as well. But what exactly will become law, we just don't know as of today. Like I said, October 20th, we're encroaching the Halloween time of the year and then approaching Thanksgiving and other holidays. And the federal government, like they did back in 2017 with the 2018 tax reform bill, they are waiting till the very last minute to introduce a lot of these changes. And I think that most of it will pass right before Congress recesses in early December, which is very unfortunate because it leaves all of us very little time to plan for all of these major changes. So to start off with, let's talk about the one thing that individuals have been discussing the most based on what they've been hearing out there from their own accountants, from the media sources, from trade journals and news articles. The top tax rate currently, as it stands right now, is 37%. Prior to 2018, the highest bracket was 39.6%. The Biden administration is repealing part of the TCJA Act, which is the Tax Cuts and Jobs Act, to increase that 37% tax rate back up to 39.6%. Now, these numbers that you see here on the screen, the $509,300 and the $452,700 number, these are your taxable income figures, not your gross income figures. So let's talk about that really quick. When the federal government introduces increased tax rates, they are increased tax brackets based on your taxable income. Taxable income is your net, basically the number after you've deducted everything under the sun off of your gross income. So if you take your W-2 and your business's profit and your Social Security income and your retirement income and unemployment income, you deduct your IRA contributions or your retirement contributions, and then you also subtract your mortgage interest, your property taxes, your charity. Once you've written off every expense that you could possibly take on your return, that bottom line number is your taxable income. So 39.6% would be the tax rate for taxable income above $509,300 if you are married filing joint, and $452,700 if you are filing single. So that bracket jumps from 37% currently to 39.6%. This might seem a little bit far off from where some of you might be filing at currently, but remember that all it takes is one sale of an asset to put your overall income above one of these two thresholds. If you're making $150,000 a year and you sell an asset with a $300,000, $400,000 capital gain, it could easily bump your taxable income well above one of these two thresholds, which could make you subject to additional taxes on the federal and the state side. So just be aware that as we approach the end of the year, you do want to set aside some time to discuss your tax situation with your tax advisor and figure out any creative ways to effectively reduce your taxable income heading into the 2022 tax filing season. Year-end planning is a big part of what we do here at Robert Hall & Associates. I'd say that it is probably more important than tax season itself because we are putting a plan in place to ultimately succeed, right? Everybody's heard the phrase failing to plan is ultimately planning to fail. And so you have to have a plan in place to hit these specific numbers to where you are not okay with the amount of tax that you're paying, but at least you've done everything possible to get yourself down to paying the obligation in tax that you owe on a year-to-year basis and not overpaying Uncle Sam and the state of California. So 39.6% would be the highest income bracket once again, up from 37%, which is where the code stands at the moment. The corporate tax rate for C corporations currently is 21%. The federal government back in 2018 dropped the C corporation rate from 35% to 21%, and the Biden administration is repealing that drop and increasing the C corporation tax rate not back to 35%, but up 7% to 28%. So meaning that if you file as a C corporation and you have any profit under that C corporation, you have enjoyed a 21% tax rate since 2018. That tax rate is now going to be 28%, which is a 7% increase in overall tax on the corporate side, filing as a C corporation. Now, some of us think that corporate America should be taxed at higher rates because they tend to be the billion-dollar corporations of the world, the eBays, the Amazons, the Googles, the Teslas of the world, which I understand why that would be. You know, the billionaires of the world, they have money even after paying a 35 or 28 or 21% tax rate. Billionaires will be billionaires. They're going to have their jets, their yachts, their cars, their houses. They're going to have that no matter what the tax rate is, unless you tax them at 100%, right? Because it takes money to make money. And so these billionaires, whether the tax rate increases to 28% or not, they're still going to have their billions of dollars. What this truly impacts, or who this truly impacts, is middle income businesses, businesses generating anywhere from $1 million to upwards of $5 to $10 million. In fact, the federal government doesn't even view you to be a large corporation. There's actually an election on a return claiming you as a large corporation. The federal government doesn't consider a C corporation to be a large corporation until it hits about $10 million in gross revenue. So you can imagine that a 21 to 28% tax rate is not going to really impact the Teslas and the eBays and the Starbucks of the world. It's going to impact individuals at $10 million or less in overall net revenue. And what tends to happen when corporations pay more income tax? They tend to slash overhead, meaning they let go of employees. They stop spending money because they're trying to retain profits to make their shareholders happy. So increasing this tax rate from 21 to 28% would probably result in less employment jobs here in the United States of America, because corporations will want to save money by cutting costs to retain overall net profits and make their shareholders happy. So I have a very unique personal opinion about this particular slide, because I do understand the general public's concern about big corporations paying a lot more in tax. But let's face it, myself as a small corporation, I do not employ tens of thousands of people here in the US. eBay, Starbucks, Google, Amazon, all of these large corporations, they have tens of thousands, if not hundreds of thousands of employees across the United States. And what do those employees pay in tax when they get paid by these large corporations? Well, not only do they pay federal and state income tax, but they also contribute to Social Security, to Medicare, to state disability, to unemployment insurance. So they in turn pay into a lot of these social pots or buckets that we will all eventually collect from if we are continuing to pay ourselves into these unique social benefit programs. Right now, we're seeing a shortage in unemployment benefit. And remember that the federal government can continue printing cash as long as they want. That's one very unique thing about the United States of America, is that we can essentially choose to turn on and turn off the money printing machine. But when you print more money, you devalue the US dollar. And so as the federal government starts to increase tax rates, there's going to be a shift. We might not feel the impact right away. We might feel the impact 2 or 3 years down the line, but it will be an impact that will not help the United States economy. So I truly hope and wish that the tax rate will continue to stay at 21%. And thank goodness it's not jumping back up to 35%, because we need more jobs here in the US. We need revenue cycling through the US economy and not wasted on federal and state income tax. We need to reinvest it back into infrastructure, which is the taxpayers of the United States of America, and all of the assets that they will in turn purchase with the revenue that they're being paid through these employed jobs. One other thing that probably will hit home with a lot of us as real estate investors and small business owners is the change to the capital gain tax rate. Currently, as the tax code stands, long-term capital gain tax is either set at 15% tax on long-term assets, meaning you've bought an asset and you've held it more than 1 year and 1 day. That is what defines a long-term asset. So you have to hold the asset for more than a year and a day. And if you sell it after that year and 1 day of ownership, you are subject to long-term capital gain tax. If your income is below $400,000, you pay a 15% long-term capital gain tax rate and a 3.8% net investment tax. So you're at about 18.8% in long-term capital gain, which 3.8% goes to paying for free healthcare here in the US. That 3.8% is also known as a Medicare tax, which once again is funding free healthcare here in the United States of America. If your income is above $400,000, your adjusted gross income is above $400,000, you are subject currently to a 20% long-term capital gain tax rate plus the 3.8% net investment tax. And that is just federal, right? That's not including the 9.3% you pay to the state of California. The federal government is talking about changing that long-term capital gain rate in the higher income brackets from 20% to 39.6%. Okay, but there is a unique calculation that is involved when calculating this new increased long-term capital gain rate. As you can see here on the screen, if you are married filing joint, $1 million of income and below would be subject to the ordinary 20% long-term capital gain rate and 3.8% net investment tax. But if you sell a capital asset or even stock at a long-term capital gain, and that long-term capital gain bumps your married filing joint income above $1 million, every dollar above $1 million in capital gain is now going to be subject to 39.6% long-term capital gain tax. That's for married filing joint. If you are a single filing individual, the threshold is $500,000. So let me give you an example below. If you are currently filing married filing joint and your total taxable income, let's say, is $1.2 million. And out of that $1.2 million, $400,000 of it is long-term capital gain. Well, $1.2 million minus $400,000, that would mean that your ordinary income is about $800,000. And if you have that capital gain on top of it, the first $200,000 of the $400,000 brings you up to $1 million, that first threshold for married filing joint individuals. So in this scenario, $200,000 of your $400,000 would be subject to 20% long-term capital gain and 3.8% net investment tax. And the $200,000 that goes above and beyond $1 million would be subject to 39.6% long-term capital gain tax. That's for a married filing joint scenario. If you are single, and let's say that you're making $200,000 of ordinary income and you have a $400,000 capital gain, you have a $500,000 threshold. So $200,000 plus $300,000 of the $400,000 capital gain would bring you to $500,000. So $300,000 would be subject to 20% long-term capital gain, and the $100,000 that bumps you above $500,000 would be subject to 39.6% long-term capital gain tax. I don't know where the 0.6 came from. I round up, I say it's 40%. So on that $100,000 that is above and beyond your $500,000 threshold, you would end up paying $39,600 in long-term capital gain tax solely on the $100,000 overage that bumped you above $500,000. This particular change is absolute insanity. I don't understand why the federal government is taxing people on an above threshold, which doesn't seem like a very high threshold, right? Especially and specifically in states like California and New York. But remember, this is a federal tax code change. So when the IRS is dialing in the final tax code, they are not thinking of California and New York specifically. They are thinking of all 50 states and how these changes would impact the United States as a whole. So other states, the other 48 states, Texas, Wyoming, Florida, Nevada, Wisconsin, these other states that have either no state income tax or very low federal average net incomes, they are not going to be impacted nearly as much as the state of California and the state of New York will be affected and impacted. So once again, we were not at the forefront of the IRS's thinking process when they were dialing in the new Internal Revenue Code. California is the highest tax state in the US, so we pay the highest state income tax here, as well as being hit with some of the major restrictions and limitations on the federal side. The state of California is going to have a pretty rough go at it over the next 2 to 3 years from a tax perspective because of these potential changes. Once again, this is speculation at the moment, and even if it does pass over the next 2 to 3 years, or once the Biden administration is up for either re-election or if somebody else is elected, a lot of these parts of the Internal Revenue Code, if they are passed, can absolutely be repealed, meaning that they can be reversed or changed. So I wouldn't suggest making any major decisions, at least just yet, with any of your capital assets, because 5 years from now, the code could be right back to where we are currently at in 2021, which is still the old Internal Revenue Code and not subject to a lot of these higher income tax rates on capital gain. Now, one thing that goes hand in hand with the capital gain topic is the subject of the 1031 tax deferred exchange. Right now, currently, as the code sits, and actually dating back to 1921, is the ability to defer 100% of your capital gain through real estate related, rental property related sales on real estate, on the real estate side of things. You have the ability to defer 100% of the gain into another like kind investment. In 2018, the federal government changed the like-kind exchange rules to where we could only exchange real property. See, prior to 2018, if you had a classic car collection, or if you had a really expensive or high-valued jewelry collection, you could exchange your jewelry or your vehicle assets for other like-kind assets. That was prior to 2018. But as of the 2018 tax reform bill, the federal government changed the Internal Revenue Code to state that if you were to exchange assets now starting in 2018, you can only exchange real property, which is rental property or commercial property, residential or commercial property, because that is considered to be a real property asset. The Biden administration says, okay, we're not going to get rid of the 1031 exchange, but instead of allowing 100% of the gain to be deferred into another like-kind asset, they are thinking of capping the overall deferral of gain for a single filing individual at $500,000 and a married filing joint couple at $1 million. So let me give you an example. Let's say that you bought a rental investment or even inherited a rental investment 30, 40 years ago here in California or in the United States. And that property was inherited or purchased 30, 40 years ago for $200,000. Let's say right down the road in Pasadena or in Arcadia, where that $200,000 property is now worth $2 million. Right? So you're seeing $1.8 million in overall appreciation over 30, 40 years. And you're thinking, well, I don't want to get rid of my rental property, but I would like to take that one single family home and maybe exchange it for a 10-unit building or a 20-unit building, take some of that equity, some of that appreciation, and actually diversify it into a multi-unit complex of some sort. As the code stands right now, currently, you could do that with the full $1.8 million capital gain. You can cycle it into another like-kind investment and not pay any income tax on the deferral of that gain. The Biden administration wants to change that. And so if you are married filing joint with this same scenario, $200,000 purchase price, $2 million sale price, if you were to sell that property into an exchange under the new rules, so in 2022, you would only be allowed as a married filing joint couple $1 million of that gain to defer the tax liability on. On the $800,000 above and beyond, you would be subject to long-term capital gain tax and potentially recaptured depreciation tax. We're waiting to hear on whether or not depreciation is a part of that calculation, but I would assume it would be. Now, doesn't this also kind of bring back the previous slide conversation? So if $1 million is allowed to be deferred and I have to pay capital gain tax on $800,000, well, $800,000 would then or might put you above the $500,000 or the $1 million threshold, making more of the $800,000 subject to a 39.6% tax rate versus 20%. Like I mentioned earlier with this particular slide, I think that these two particular changes are absolutely insane. I don't understand why the federal government wants to hit people in their real estate portfolios, because I know as a real estate investor myself that a majority of my retirement, majority of my parents' retirement, a majority of their parents' retirements were in real estate assets. So now all of a sudden you're talking about penalizing people who make great financial decisions with their real estate activities and now taxing them more on all of the money that they're trying to build as wealth retention to survive on in retirement. It's absolutely crazy. And so for single individuals, the deferral of gain would only be capped at $500,000. For married filing joint, it would be at $1 million. Now, yesterday, I gave two webinars of this exact webinar, one in the morning, one in the evening, and I was asked the same question in both webinars. what if I enter into the exchange prior to the end of the year? Am I subject to the current tax code rules, or am I subject, because the property would then close in 2022, the new property, the new acquisition would close in 2022, what would I be subject to? Would I be subject to the current tax rules or the new potential tax code changes? And I would love to have a definitive answer for you, but we just don't know at the moment. The federal government has not talked anything in detail about what they are going to prorate into 2021 and what they're going to allow in 2022. However, I've worked in this industry long enough, and Bob Hall has been in business for 50 years, and I've had conversations with him about what he thinks is going to happen. And I think that this is what will happen, because this tends to be 99% of the time, this is the case, where the government would actually grandfather you into the old rules if you enter into the exchange before the end of the year, versus making you subject to the new rules. Let me give you another example to kind of better understand how that works. Let's say that in your neighborhood, you've lived in your primary residence, let's say for 50 years. And there's this long road in your neighborhood, and you've driven down this road 10,000 times. And all of a sudden, the city decides to put a stop sign in the middle of that road. And you leave your house in the morning and you drive and you blow right through that stop sign. And it's the first day that it's been there. And a cop pulls you over and says, hey, you ran that stop sign. I need to give you a running a stop sign ticket. But I also need to give you a ticket for all 10,000 times in the past that you passed through that stop sign without stopping. And you're saying, well, the stop sign's only been there for a day. And he said, well, no, I mean, the stop sign is there now, but we know that you've passed this corner 10,000 times. So we're going to hit you with a rolling stop sign ticket or whatever that ticket is, 10,000 plus one. Well, that's kind of a similar situation here. If you enter into the exchange under the current tax code, but then all of a sudden you close in 2022 and the government decides that, hey, you need to play by the new rules, that is very similar to that example I just gave you. It wouldn't seem, well, I don't want to use the word fair or unfair when discussing Internal Revenue Service, code, but at the end of the day, it wouldn't make sense for them to go back and penalize people who entered into the exchange not knowing or understanding what the actual Internal Revenue Code for 2022 would be. So the government will allow people to be grandfathered into that current rule. However, we need to better understand when this code will start. Because back in 2018, the federal government introduced new code for 2018 in 2017, and some parts of the code stated that they started December 15th of 2017, not January 1st of 2018. So I think that the best play, because we don't really know what the dates are going to be for this 1031 exchange change, I think that as long as you enter into an exchange prior to December 15th of 2021, this year, you should be grandfathered into the current revenue code. But do not quote me on that. I am just taking 17 years of experience working as a tax advisor and giving you my professional opinion about where the dust may end up settling around this. If you enter the exchange after December 15th of 2021, you may be subject to the new rules, which could start either January 1st of 2022 or potentially December 15th of 2021. Just to get that in the books. And even if you close in 2022, I do believe that you would be grandfathered into the current rules. But we will have to wait and see what the final verdict is over the next month to 2 months, hopefully before Congress recesses in early December. But this involves a number of things, right? Because if they cap you at 500,000, if you're a single filing individual and $1 million married filing joint, and everything above and beyond that is subject to long-term capital gain tax, you also need to take into account and plan for the potential long-term capital gain change that we talked about in the previous slide. Okay, very, very unique calculation here. We need to make sure we understand that we should not be fire selling assets just because of these potential changes, because 4 or 5 years down the line, when we have a new elected presidential candidate or somebody completely different in office, maybe Biden gets reelected, maybe he doesn't, whoever that next president is going to be, they'll understand more about how his codes change the United States economy. And so they very much have the power to repeal a lot of Biden's Green Book if they are in office at that time. So once again, entering into an exchange now might not be necessary because the code absolutely could change, in the next half decade. Okay, so always keep that in mind. Now, another big change to the estate exemption is the ability to take losses attached to an estate or attached to assets upon death as a write-off for your next of kin. Now, that's a lot of verbiage there. So let me dial back. Right now, currently, if you pass away and you leave assets to your children, any losses that you've never been allowed to take are not tax deductible for your children, for your heirs, because there's something currently in the current Internal Revenue Code called the stepped up basis benefit. Stepped up basis means that when you pass away, if you have $10 million in assets that you're leaving for your children, and the $10 million is made up of real estate investments and stock investments, your children inherit those assets upon your passing, upon the date of death. Your children or your next of kin inherit those assets with a full stepped up basis up to the current estate exemption of $12 million. So that essentially means that if you have $10 million of assets, that your basis in those assets, because you purchased them over the past 50, 60 years, let's say your basis is only $1 million, but now those assets are worth 10 million. Well, I mean, if you sold them while you were still alive, you'd pay capital gain tax on $9 million, right? Because you saw all of that appreciation. But if you pass away, if you die and you leave those assets to your children, I know it's kind of a dark topic to think about, but it's very important to do end of life planning. And if you leave those assets for your children, currently your children receive and inherit those assets with a basis of $10 million, and they can sell the $10 million of assets tax-free. That's how the code stands now. It's called the stepped up basis benefit. The Biden administration under the Green Book is talking about getting rid of the stepped up basis benefit, which means that if they get rid of that, your children would inherit your basis, but they would also be allowed to take any unallowed losses that you have not been allowed during your lifetime to offset any potential gain. This is one of the most significant changes to the Internal Revenue Code over the past 40 to 50 years, this particular change in general. I don't, once again, I really, really hope, my wish and my hope is that this does not change, because this would mean significant tax liabilities for your heirs if they ever decided to liquidate your assets after your date of death. The carry forward loss benefit, that might be a little bit of a benefit, but you're not going to have $9 million in losses to offset $9 million in gain. So what we're starting to see preemptive to the potential tax code change is a lot of parents transferring assets to their children preemptively. I think a little bit premature for that particular asset transfer, because what you're doing is you're transferring an asset while you're still alive, and now your children have inherited your basis. And that was all solely based on speculation, right? Because we don't know if this particular part of the code is going to change. We will not have very much time before the end of the year to make those changes. And I think that kind of consciously, the federal government understands that if they passed this code earlier in the year, they would see a lot more individuals transferring assets to their children. So like everything that the government does is they play the chess game, and they say that they might change this, but they don't know for sure. And if they change it on December 15th of 2021, it only leaves us with about 15 to 16 days to make these transfers, which the government knows that it's going to take longer than that to do those property transfers. So just understand that you need to keep your ears low to the ground, essentially, hypothetically speaking, to hear about any potential finalization of the Internal Revenue Code. Once it is finalized, I will revamp this whole webinar and bring it right back to you with updated information. But this particular change could mean significant tax implications for your next of kin and the next generation, leaving them with very little of what your overall asset values were, because if they sell it and they decide, well, hopefully they keep your properties. Hopefully they understand the value of real estate, the value of dividend paying investments. But if they don't have the option of exchanging the property anymore, and they don't have the stepped up basis benefit, if they do sell those properties, they inherit your tax liability on all of these assets. So just be aware that this is a potential change under the Biden administration Green Book. Absolute insanity, in my opinion, but to each his own. part of the green book that is not such a bad thing in this case. A lot of the other things are a little bit of terrible changes. But one thing that the Biden administration is bringing into effect is for properties that start construction after December 31st of 2021 will potentially receive a 30% investment tax credit. So they are actually reinstating or restoring the investment tax credit of up to 30% on eligible properties. Now, there's a whole list of things that would make your property eligible for this credit, but the construction has to begin after December 31st of 2021. So just be aware that this is not something that would be constructed in 2021. I'm sorry. It wouldn't be new construction this year. It would be new construction that starts after the end of this year. So we have to keep an eye on this and see what exactly the finalization is around this 30% tax credit. It could end up being a major credit for developers. But once again, developers are the ones that tend to make a lot of money and pay very little in tax. So giving the credit to developers, in my opinion, was kind of silly because they already are able to reduce their liabilities by their overhead dollar for dollar. So the goal with development is to pay overall less income tax because they get the greatest benefit under the current and future internal revenue codes. So just keep an eye on this if you are in the development stages of properties, or if you are thinking about developing property, there may be a nice credit on the horizon for you as a property developer. Excuse me. So many changes on the horizon here. We've heard that the taxable income figure of $400,000 being talked a lot about in the media outlets and on news media stations, in trade journals and news articles, and $400,000 across the U.S. Remember, when you're talking about all 50 states, $400,000 is a pretty high level of income, especially in states like Wyoming and Wisconsin and Delaware and Alabama. But here in the state of California and the state of New York, for instance, $400,000 could simply be a dual income household. Somebody making $180,000 over here and maybe a self-employed real estate professional making $220,000, right? And all of a sudden you're at 400 grand. So in the state of California and New York, the two states that have the highest number of dual income filers, 400 grand doesn't seem like a whole lot of money. I know that I'm being very vague with that, but we tend to have higher income earners in these two states, California and New York. So across the US and the other 48 states, $400,000 tends to be a higher level of income. And the federal government, when they are passing new internal revenue code, they do take that into account. They say, well, we're not going to create tax code changes that benefit Californians and New Yorkers. We're going to make tax code changes that benefit the United States as a whole. And so at $400,000, that's where you're going to start to see a significant tax change. We are seeing, obviously, the Medicare tax at 3.8% on any capital gain or dividend investments. The federal government is going to focus a lot on cryptocurrency traders as well, starting to hit them with significant penalties for underreporting income or not reporting them at all. So there is a box on your tax return now that you have to check if you do own or have traded cryptocurrency. I'll give you a specific example. During the pandemic, I had a client, a single mother who has a 15-year-old son who's into computers and gaming and everything. And she wanted to give him something to do at home because he wasn't able to go out and play with friends during the pandemic. So she set up a brokerage account for him and put like $5,000 in it, something that she wanted to kind of show him how to trade things with. And in his Robinhood account, this 15-year-old, 16-year-old child, using his mother's Robinhood account, because it's all registered to her social security number, he turned $5,000 into $102,000 of capital gain. At 15, 16 years old. I almost wanted to hire him to trade in my accounts, but it was all under his mother's social security number. So when she came to do her 2020 tax return, I said, well, you said you set up a Robinhood account under your name and your son was trading. And she said, oh, but I haven't even looked at it. And I said, well, it's reported under your social security number. Do you know what he was trading? And so he wasn't there with her, but he had him log in and download the document, and they sent it over. And I saw $102,000, well, not $102,000, it was $97,000 in short-term capital gain from the trading of cryptocurrency. And so she came in thinking that she was going to get a little bit of a refund, when in fact she ended up owing quite a bit of money on all of the short-term trades that her son made. Now, she wasn't angry because her son made her $100 grand, but she wasn't managing that account at all. She didn't know what he was doing. And so it was kind of a little bit of a surprise. Well, not a little bit, a big surprise to her. But we had to then check the box on her return that she had traded, received, or sold cryptocurrency on her return, because that 1099 that Robinhood files with the federal government showed that there was short-term assets in the crypto space that were sold or exchanged or received. So it's very, very important for you to check that box, because at the end of the day, if she didn't check that box on her return and the federal government caught wind of this Robinhood account, because the 1099 is clearly in the IRS's computer system, the penalty could be up to 50% of the value held in that Robinhood account, and she'd be looking at tax evasion charges. So it's incredibly, especially under Biden's administration and the focus that they're going to have on these listed transactions, that you check that box that you did in fact trade, receive, or sell cryptocurrency during the calendar year. Very, very important. Okay. That was more of a success story on their end, but she was very surprised with the tax bill and was willing to pay it, but had to liquidate some of that great gain that her son had made for her in the account to pay it. Very important for you to focus on this. And if you are at $400,000 married filing joint income or as a single filer, it is incredibly important for you to sit down with your tax advisor prior to the end of the year to create ways to effectively reduce this taxable income and possibly keep you in a lower income bracket and not subject to some of these significant limitations that are on the horizon under the Biden Green Book. So we'll get to Q&A now. I did want to leave this up on the screen mentioning that we do offer free consultations. I've always offered this in my webinars. We'll review 2 years of tax returns, 2020 and 2019, check to make sure everything was reported correctly, see if there are any audit triggers or red flags that kind of stand out on the return to us as tax advisors. And then we'll also put you on our periodic tax email update, letting you know about when the Biden administration does finalize their tax code, and also let you know about our free educational webinars and all of the events that we have coming up over the next couple months. So this might not only be for the free consultation for you. If you want to avoid the free consultation, at least be a part of our email updates so that you know about very significant changes that are going to be passed before the end of the year and what that means for us as US taxpayers. Okay, so let's open it up for Q&A.
Thank you so much, Tony. So everybody here, if you have any question, would you please unmute yourself and let us know if you have any question, or you can text that on our chat box. Let's give a second seeing if there is any question. But Tony, I have a question for you.
Mm-hmm.
Okay, so for the consultation, do we usually have to meet up and see the client in the office? Is that possible we can do it like virtual?
Absolutely. In fact, right now, it's sad to say, but about a month and a half ago, we had a COVID outbreak when we tried to open our office back up. So we had to shut back down based on what the city of Glendale and the city of Los Angeles said about our particular business. We see 100 to 120 people on a daily basis, clients that come in and out of our office throughout a workday. And so we had to make the decision that was best for not only our clients, but our staff to then shut back down. We don't have a definitive opening update for in-person appointments just yet, but since the beginning of the pandemic, we've actually set up a pretty nice platform to do things by phone, to do things by FaceTime, by Skype, however you would like to connect with us to initiate that free consultation. We are available digitally.
Okay, great. Thank you. Thank you. Let's ask again if we have any question out here. Pauline?
Hopefully nobody had any heart attacks.
No, this is
thank you.
Yeah,
So
yeah. Thank you so much. This is a great presentation.
Thank you. And like I said, as soon as I have, I as a tax advisor, I always like to give definitive answers to questions. And right now there's just so much, there's so much uncertainty as to what will be finalized. And I don't want, one thing that I do want to mention again, I don't want you to go out and make any rash decisions with your financial situation and your properties without knowing all of the final terms. I know that it's easy for me to say because, you know, I'm not looking to exchange anything. I'm a buy and hold real estate investor. I'm not looking to exchange anything at the moment. So it's easy for me to say, don't make any major decisions. But if you do make those decisions and the code doesn't pass the way that the Green Book currently states it, it could have been a bad decision for you financially. So we're kind of stuck between a rock and a hard place at the moment because we just don't know. And this is all because the federal government just, you know, really doesn't care too much about the needs and the wants of the taxpayer these days. They don't give us enough time to plan. It's just it's as simple as that. And you know, once again, we can argue and talk about politics and political stances and everything. It has nothing to do with politics. This is Internal Revenue Code, things that have been around for over 80 years. I mean, 1921, that's almost 100 years that the exchange industry has been around that's allowed us to defer capital gain through an exchange. And the Biden administration is changing a code that's been around since the beginning of the Internal Revenue Code. I mean, it's insanity, and it will impact an industry that not only employs, the 1031 exchange industry employs over 600,000 people here in the US and generates over $35 to $40 billion in collected revenue for the federal government on a year-to-year basis. So I feel like this potential change is very short-sighted on the government side. And I don't understand why they would mess with something that is just such a great opportunity for people here in the US to build wealth and retain wealth and leave legacy for their next generation. It's very, very, very confusing to me why that change would be possible. So.
Thank you very much for your answer. Great. Pauline.
Thank you so much. We learned a lot today, and then we really learned the most updated information from Tony, your great presentation for unpacking President Biden's Green Book. Thank you very much, Tony and Gloria, for this wonderful section. If you have any further questions or you need a consultation with Tony, please text Robert Hall and the number 72000 to get more detailed information. And maybe you need to have a smart plan for in this 2 months to decide it, right? I will contact with you, definitely. Okay, yes. On behalf of West and Gable Valley Realtors, we really appreciate your valuable time and your expertise with us. And we thank you again, Mr. Tony Watson, Robert Hall, and Associate for your wonderful and important update and presentation to us today. We hope to see you in person soon. And a quick reminder, this Friday, we have another very good class, 11 o'clock, ADA compliance and disability access claims. And next Monday and Wednesday, we have the 2 class offered by Edison, Certified Green Lending Professional Training and ADU class. And don't forget, register for November 2nd, new RPA residential purchase agreement form and training by Golf Hutchinson. And thank you again, Tony, Gloria, and Fong, everyone. What a wonderful morning. We learned a lot of updates. Thank you. We'll see you soon. Thank you.
Thank you.